Two big banks reporting. We got Bank of America, which is like a big retail bank, and then we have Goldman Sachs, which has a huge investment banking business. Which one of these banks will tell us more about the financial sector?
Well, if you want to know about banks, you look at Bank of America. They've seen their cost of funds climbing rather dramatically in the last couple of quarters. And, you know, the bottom line is they're a large Main Street bank. They obviously own Merrill Lynch, but they are an enormous store of assets, and they keep a lot of their assets. They have one of the longest duration books of all the major banks on Wall Street. Goldman, on the other hand, is trading. You're looking to them to tell you about whether or not they picked up on the bond market rally that really started at the end of the third quarter. And, you know, they have to talk to us about the bank. David Solomon indicated in February that there was going to be news about their Marcus effort and also their technology platform. So I think investors really want to hear about that.
All right, so a lot of people are talking about deposits. You're also looking at credit loss provisions. That's the money that banks set aside for loans that don't work out or don't get paid back.
Right.
So during the pandemic, Q2 of 2020, the big banks, they set aside $60 billion for those credit loss provisions.
And we didn't need it.
Didn't need it, okay. How much do you see them setting aside this time? We have worries about a recession.
Right.
We have worries about the consumer. We have worries just about the banking sector in general. How much do you think they're going to set aside now, and will they need it this time around?
I think they will. It'll be a much more gradual credit build than we saw in 2020 because nobody knew what was happening. COVID, the only benchmark they had was 2008. So they basically did the same thing. This time around, I think they're going to wait and see just how much pain there is on the part of the consumer. And it's going to be a slow build, but it'll still be there. But third, fourth quarter, we're going to be talking about credit instead of deposits.
Is there also a Fed impact with the Fed no longer buying bonds? Does that deeply impact these banks?
Oh, tremendously. I mean, it's like 1980. It's like Paul Volcker's at the Fed, because, or late 80s, because, you know, think about it. You have T-bills at 4%. The banks don't work for 4%. They're working for maybe 1% net once they pay for funding and SG&A and everything else. So it's a really weird time for banks. And basically the Fed is saying to them, raise your deposit rates as fast as you can. That's hard to do.
Which obviously hurts net income interest.
Oh, yeah, I think you're going to see a NIM squeeze. In other words, funding costs are going to be going up. But until the Fed really starts to sell a lot of the securities in their portfolio, there's going to be a cap on asset returns.